Alibaba is a stock that I've been meaning to look at for quite some time, and finally I'm getting around to it and seeing why analysts are all in agreement that this is a buy. It's essentially split half and half between buy and strong buy amongst analysts. And with the price that it's at right now, I think that I should be buying this as well. So we're coming up with a fair value right around $200, discounted cash flows of right around $200. In fact, across every single valuation metric, the expectations for this year price the stock at 175, which is about $100 higher than it currently sits. So twice the current share price, which could pose an opportunity. I know it's a stock from China, so there's a lot of fear about that whole situation. I think the benefit might outweigh the risk here. Earnings yield super high, 31%. This thing typically trades at a pretty low PE. It depends on what multiple you want to use for that portion of the valuation, because they usually have really high earnings in the 20s to 30s. In fact, in 2021, their EPS was 55.62, and their PE tends to be really low, like 3 to 5. So even if we do adjust that, where it's currently at 8, let's just say 5, and see where that puts our fair value. Drops down to $155, which is almost exactly twice the current share price right now. So even with that, I think that it's definitely reasonable. Cash flow yield looks really good, nice strong double digits, 19, typically around 20%. They don't have a dividend. ROE, ROI, and ROA are okay. ROE and ROI right around the lower end of what we like to see. ROA is a little low, but they have a lot of assets. Debt to equity looks good, 0.66, probably one of the best stocks that we've looked at. Gross margin, just about 37%, down from the almost 40 that we've seen over this last few years. And net, 8.35, almost half of what we usually see, the 16.5. So margins did come in lower this last year, but they're still within the range that we really like to see on a stock. 30 gross, around 10 net. Now, growth wise, I'm getting both the historical data and the analyst projections from the same source, and there's a huge drop. There's a analyst projection of 8% growth over this year to next year for the revenues, which definitely seems pretty reasonable looking at how they have historically done. So pretty big dip from last year to this year, but going forward, it looks like it will get better. Share count, they almost always buy back 1.5% of shares. Cash flows, 7%. If they're coming in with 8% revenue, would get them up to 19.4 cash flow yield. So essentially hold even with where they're at, which is still lower than what we've seen out of them. Assets and liabilities have pretty well gone in line. Liabilities kind of outpace the assets, so I guess we could adjust that to make it a little bit more reasonable, more of a worst case scenario. Again, no dividend. They are paying a special dividend of $1, but aside from that, nothing. And then margins, if they're able to grow their margins at 4%, then they'd be back above 10% in 5 years, which is what we really like to see. Again, they've averaged since 2020 16.5%. So that's probably a little low. And what all this will get you buying at today's share price, a 90% growth over the next 3 years in the fair value of the stock, bringing you $65 of profit if you're buying at the current share price of 72, as long as it can achieve the fair value. And then in 5 years, you'd be looking at $84 in growth, or 117%. So doubling in the course of 5 years in the fair value. And the average return in this case would be 6.75%. Now, we can adjust some of these numbers as I just did. The liabilities seem to have impacted it quite a bit, showing the impact on the balance sheet portion of the valuation. But 6.75 is not too bad. Of course, the biggest lever that we're going to have is with the PE ratio that we use for our calculations. And right now they're sitting at 8. 10 is more than reasonable. 20 is typically what we see for stocks. 10 to 15 would be ideal. And that would get you 7.23% at 10. And if we adjust that all the way up to 20, which would probably be about the highest that I would be willing to pay for most stocks, you're getting up to 8% annual returns, which is very fair, in line with the markets and with the stock being undervalued. Definitely a reasonable pickup at today's prices. The questions here are, is the government of China going to leave Alibaba alone to do its thing? Is the US going to interfere with China's economy in any way, any sort of sanctions or bans? I'm not sure that that would be a 100% impact to the stock, cutting it in half. There would definitely be workarounds in those situations, and a company like this would definitely survive. So it's on my watch list, and it will likely make an appearance in the monthly 5 stocks that I'm buying, because it is very undervalued and the growth is definitely reasonable here. So let me know what you guys think about this stock. Like if you enjoyed the video, comment any other companies that we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.